Bank of Canada says mortgage payments could spike 40%. Uh-oh, we're in for some trouble. And the second article we'll be reviewing is Bank of Canada needs to crush inflation with another rate hike, according to a Scotia economist. And the third article we'll be talking about is how Tiff Macklem, the head of Bank of Canada, says that inflation is coming down despite it spiking in April. I'm going to be breaking all of this down for you in this week's episode of Prime Properties TV. And if you are looking for some help on how to navigate this real estate market, whether you're buying, selling, or investing, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and a question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a RE/MAX in the Greater Toronto area, on top of making awesome educational real estate content for you just like this one. And if you are enjoying our content, make sure we spread the knowledge by smashing the like button and subscribing to the Prime Properties channel. Now, the first article we'll be covering is Bank of Canada says mortgage payments could spike as much as 40%. Very attention-grabbing, very well written, almost like Toronto Star headlines. Well done, Globe and Mail. But what they're basically saying is that not right now, but the bank said that by 2026, nearly all borrowers have renewed their mortgages, resulting in higher payments. Meaning 5 years is the average length of the mortgage term that people have gotten between 2020 and 2022. So, 2020 to 2022 plus 5 puts you at 2026, 2027. So all of those mortgages that were originated between like 1 to like 2%, they're all coming up now and they're all likely to have higher mortgage payments. Now, obviously, they're just predicting where the interest rates are going to be by that time. And I would say without a doubt, almost it'll be higher than what it was in 2020 and 2021 because that was a little bit of an anomaly. Now, are they going to be higher than what they are now? I don't think so. Are they going to be lower? Probably. How low relative to 2022? Nobody knows, right? So that's kind of why everyone's kind of talking about this stuff. Now, what they have here saying is that, but given that most variable rate borrowers have fixed payments, so this is everybody except for Scotia, meaning their payments haven't moved. We talked a lot about this with the trigger rates. They have to pay more every single month. Now, instead, a higher share of the monthly payment has gone towards interest and it's pushed back their amortization beyond 30 years. So we have a lot of people with amortization 40, 50. There's some people with like 70 and 80-year amortization. At some point, it becomes infinite because you're negative amortizing. And every single bank has a different rule about it, but that stuff is adding up. Now, here's kind of where the interesting thing takes up. When these borrowers renew their loans, they will require to revert their original amortization schedules unless they refinance and take out a new mortgage. So this is kind of like the key thing right now. Like even one of the mortgage insurance for anyone under 20% down payment, they're allowed to go from 25 years to 40 years. So it kind of dragged up the amortization. Now, what's going to happen is if a lot of people bought and they're right up at the 80% loan to value and say prices don't increase by 2025, then yeah, we're going to be in some trouble. But at the same time, if the banks and OFC, the banking regulator on the back end allows people to amortize, and I've been saying this for 2 years, the easiest way out of this without increasing interest rates anymore is to extend the amortizations, right? So it's already kind of being done in the background, right? But if you don't do those things, then likely their payments are going up by 40%, which is a lot of money because on even like a $500,000 mortgage, say that's $2,000, 40%, that's going to pull you up to almost $3,000. It's a lot of money. It adds up and wages haven't gone up, obviously, right? So they're saying that if you were on a fix, it'll probably increase 20 to 25%. So regardless, payments on mortgages are likely going to go up. And if you're on a variable or static one, you've been negative amortizing, probably up 40%. If you're on a fixed, still up probably 20 to 25%. So regardless, the cost of housing is going to go up. Now, some people argue prices are going to come down for that. Again, we'll see where it's going to go because this is a future of 3 years kind of problem. Now, here's kind of the interesting thing. So Caroline Rogers, who's the senior deputy governor of the Bank of Canada, dismisses the idea of permanently extending the amortization for new mortgages, which is perfect. But again, the way I am reading this is that for new mortgages, meaning for new people who are first-time home buyers are not allowed to get, call it this new amortization of 40 years. So this looks like a bailout for current homeowners yet again, right? Because the Canadian housing market keeps getting backstopped by the government or the banks in some way, shape, or form. But she said that lengthening amortizations for existing borrowers can help provide relief to those struggling with higher mortgage payments. And look, it's already been happening in the background. I've been saying it's been happening for a while already. And they even put in the Canadian budget that they're going to have banks talk with their kind of existing clients to extend amortizations if they are showing some kind of financial stress, and have clients who are able to even convert some of their mortgages to interest only, and some have already gotten 40-year amortization. So again, backstopped for homeowners, for new buyers who are kind of waiting for the market to crash so that they can get into the market. Unfortunately, that's kind of why they're upset, right? And this is exactly why the whole idea of real estate prices can't fall down is because despite what people are saying, the actions that the government are taking keep coming back to backstopping the prices and not letting them fall any further. Now, the second article we have here is Bank of Canada needs to crush inflation with another rate hike, Scotia economist says. So Derek Holt is the economist from Scotia who said that we're going to see 8 rate hikes that nobody believed them, everyone laughed them, but turns out he was actually correct / also wrong because it was way over. That was 14. But anyways, he was the closest to how fast the rate hiking cycle was. So he's saying right now that we need to increase interest rate to crush inflation right now. And I actually agree with him, right? To a certain extent. So he has over here saying that Stats Canada, and this was about 2 weeks ago, right, saying that the CPI was higher than normal. It actually went up. The core actually went down a little bit. But at the end of the day, the headline CPI is higher than normal, and it's freaking some people out. And it's also saying that, hey, look, because inflation is surprisingly going on the wrong direction, we actually need to crush this more because we can't keep having high inflation for a long duration of time, right? I tend to agree with the stance that we should raise the interest rates despite it being negatively impactful in the real estate market, because we need inflation to come down, and keeping up at this rate is going to be bad. Look, he's saying that they need to raise it because it needs to bring it down to 2%. I personally don't think it's come down to 2% ever unless they fudge the number some more. But I think 3 is probably going to be the new standard. But the problem right now is that when you raise interest rates, it's kind of counter-cyclical, where a component of the CPI is actually from raising interest rates. So it's like a circular reference. Like if you use Excel, it's like this is referencing that, right? So that article is from over here, and you can check that out. But the idea to raise it so that the sentiment kind of tapers down is actually a smart one. Now, will it ultimately kind of have a drag on the real estate market? Yes, but at the same time, a lot of people still have 3-year fixes right now that they're buying homes for. Now, the bond market did go up because the CPI print higher. And again, the banks haven't necessarily adjusted yet. They may have adjusted next week, but we're going to see shortly. But at the moment right now, I agree with the stance that inflation needs to come down because it's a very big drag on the economy, and it's probably going to make the recession worse. So might as well kind of rip the band-aid and get it over with. Now, currently, the market is saying that, there's going to be a rate hike in June, there's a rate hike in July. I don't think there's a rate hike in June, maybe in July. It depends what the CPI print is, because you have to remember the highest point of inflation was June 2022. So if, say, the inflation print comes closer to July, where the interest rate announcement is, and we don't see it come down, I wouldn't be surprised if that's when we get the rate hike in July. Because you have to remember, the head of Bank of Canada says that it remains prepared to raise the policy rate further if needed to return inflation to the 2% target. They kind of left the door open, and maybe they'll follow Australia in raising the rates. Maybe they will. Again, it's all TBD. No one really has any idea, because until mid-May, everyone thought inflation was coming down, rates are going to get held. But then once the CPI printed, everyone was like, oh no, 180 degree, right? So new input, new output. That's what I've always been saying. And the last article we have here is Bank of Canada's Macklem says inflation coming down despite April gains. This is kind of him like, guys, calm down. It's cool. It's up a little bit, but it's coming down. And I tend to agree with them. It is going to probably come down again because of the base effect in June, where it was really, really high. But the fact that it printed a little bit higher in April is kind of spooking everybody out, right? So he assures everyone it is coming down, even though the numbers published were a little bit higher than normal. And this was all before the market said that was an 80% chance of a hike in July after it dropped to 60%. Again, we're going to have a couple more prints come July, and that's going to dictate whether it's going to, make the Bank of Canada increase interest rates or not. And remember, again, I've been saying over and over again in this video, June is probably going to be the highest base effect because it was 8.8% inflation last year. So relative to now, it's still going to be much lower. So it should have some kind of a downward trajectory. So I still think interest rates are going to be staying high for a little bit longer. And that's why the 3-year fix has kind of been the most popular mortgage. And despite all the things that are happening, I do think interest rates ultimately in the short term will come down. Just maybe not short term in the next 6 to 12 months. They may stay high, but after that, it'll probably come down. But again, nobody knows, because the minute the CPI printed even the tiniest smidgen high, remember, it came up 0.1 higher, everybody lost it. The market was like, oh my God, everything's flipping out. Everything is really volatile now, right? So that's kind of why, for you to avoid the volatility, it's best if you're getting a mortgage right now to go with the fixed. If you have a fixed rate hold, you probably want to execute that before it expires, because if you are renewing for mortgage right now, you may want to go apply for it right now before the mortgage rates for the fixed actually go up, because the bond market did actually go up. So this is why like it's so difficult for anyone who's like in the real estate market right now trying to buy and sell, because like things keep fluctuating like crazy and there's so much news over it because it's volatility. And at the end of the day, I keep saying this, long term, I'm super bullish on where Toronto real estate is going to be, but you have to survive the volatility, which is why managing your own personal cash flow or your portfolio's cash flow for investment properties is very, very key right now. So make sure you increase your rents, reduce your expenses, and if you need to sell something just so that you don't have to go bankrupt or, take a second mortgage on something, it's probably a good idea to do so. Now, if you're looking for some help how to navigate this real estate market, whether you're buying, selling, or investing, or you just want someone to talk to you about your portfolio, about whether you should actually, cut something off, or you can restructure a couple of things, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Now that I'm done watching this video, I think you should check out this video. And you know what? Why don't you check out this video too?